Good afternoon, everyone. Good morning or good evening, depending where you are. Welcome to the World Investment Forum. My name is Jean-René Giraud. I'm the founder and CEO of Track Insight, the global ETF data and analytics platform. We have several million private and professional investors learning about ETF investing on our platforms. And that gives us a unique insight and view into one of the most profound shifts in investors' behavior, namely sustainable investing. But beyond ESG investing, what we witness every day in their behavior is the rise of purpose investing. Purpose investing is about finding a purpose, a meaning for the investor that goes beyond performance, risk control, and also to offer a better understanding of the meaning of their investment and where the capital is actually going into. And this is a profound, if not systemic change that we see in how investors, retail and professionals, allocate assets. Now, ESG is a very confusing term. ESG doesn't mean a lot for a lot of investors. There are actually very, very sound definitions of the E, the S, and the Gs, but they remain very conceptual. The 17 Sustainable Development Goals, SDGs, are the cornerstone of an initiative launched in 2012 in Rio, and they were formally adopted in 2015 and can be considered as a culmination of this transformation. The culmination because finally we put words on what it means changing and making an impact on the planet. 17 SDGs, couple of hundred more detailed objectives. This is really what people are hungry to understand on how their investments affect the changes in the world. Track Insight has been cooperating for years, 3 years, with UNCTAD, and we were amongst the first to offer an independent view on how 840 ETFs listed globally and totaling in excess of 300 billion respond to SDGs. Those can be found on trackinsight.com. But to put things into a broader perspective, because this is not only about ETFs, what we explain here is only part of the 1.7 trillion of assets invested into ESG funds. I'm personally very into the concept of the SDGs because I think it's probably the best way to offer the choice to an investor to decide where to allocate their capital. It is something that investors understand, that makes sense to them, and we're not speaking governance, we're speaking changing the climate, changing poverty, and really impacting upon society. So that's why I'm really delighted that UNCTAD asked me to moderate today's panel. It is a challenge. You have a lot of faces on the screen, so we have 7 of the most senior industry professionals on the planet that are involved into ESG investing, and I'm really, really proud of the panel we have. And I would like to thank James Zhang, who invited me to run this panel. James has been the Director of Investment and Enterprise at UNCTAD. For those who don't know UNCTAD, if anyone, it's the United Nations Conference on Trade and Development. And he's been at this position since 2009, and he leads the preparation of the annual World Investment Report. I really suggest and encourage everyone to read the World Investment Report. It is a big piece, but it really gives you an interesting viewpoint on how capital is deployed globally. James also initiated the World Investment Forum in 2008, and he played a leading role in building the WIF, the World Investment Forum, into a global brand in the field of international investment. And I like the fact that we call this a brand because the SDGs is all about communicating up to the retail investors. That's going through the professionals, the institutions, but also the retail investors. And for this, branding is very important. So thank you very much, James. And I'd like to welcome you on the stage, the virtual stage, for your opening statement.
Thank you very much, Jean-René, for the kind introduction. Distinguished speakers, ladies and gentlemen, I'm very pleased to welcome you to the International Sustainable Fund Conference. Today, we have with us a very distinguished panel of leaders from the fund industry, from both the demand and supply sides, to discuss how to leverage investment funds for sustainable development in the new era of global economy. Capital markets have a decisive impact on the level and the directions of sustainable investment. They can contribute towards filling the financing gap for the sustainable development goals. In the last few years, the pursuit of sustainable development has led to a significant increase in sustainability-themed financial products. The global efforts to fight the pandemic and climate change are accelerating this momentum. UNCTAD estimates that the value of sustainability-themed investment products amounted to $3.2 trillion in 2020. And the sustainable investment funds have emerged as an important vehicle to channel much needed investment into a wide range of sectors that are critical for the achievement of sustainable development goals. Over the past 5 years, sustainable mutual funds, including ETFs, quadrupled in assets under management and more than doubled in number. By June 2020, the number of funds that claim to be investing with an ESG or sustainability purpose had reached nearly 4,000, with $1.7 trillion of assets under management. Sustainable funds have been deploying much needed capital in a wide range of key SDG sectors, such as health, renewable energy, food and agriculture, water and sanitation, and clean tech. Meanwhile, as major share owners of many public listed companies, fund providers play a critical role in pushing sustainability integration along the investment chain through voting and investee engagement. However, the transition to more sustainable investments for the fund industry is still in its early days. Despite their rapid growth, the total assets of sustainable funds only account for 3% of the entire fund universe. Moreover, most sustainably themed investment products are domiciled and invested in developed economies, and most are self-labeled, raising concerns about sustainability washing and consistency of standards. Much work has been done over the past decade to address these challenges, most notably in integrating sustainability into different parts of the financial system, including by asset managers, asset owners, banks, insurance companies, and stock exchanges. Slowly, regulation is also catching up with market trends, helping to shape the future contours of the sustainable investment market. To support these efforts, UNCTAD will launch the UN Global Sustainable Finance Observatory. And this will be launched at this forum on the 20th of October. Our vision is to build a future global financial ecosystem in which sustainable development, as defined by the SDG, is fully embedded into the business model and investment culture. Hopefully, this will bring more credibility, transparency, and consistency to the market. As a concrete action under this new initiative, UNCTAD will announce the winners of its first Sustainable Fund Awards on 20th October at the forum. It aims at recognizing outstanding sustainable funds that demonstrate the highest standards of sustainability and impact while outperforming their respective financial performance benchmarks. In doing so, we can set good examples and disseminate best practices. UNCTAD is committed to supporting the funds industry in the transition to more sustainable investments. With this distinguished panel, I am confident that our meeting today will be able to come up with specific ideas to mobilize more investment in the post-pandemic recovery and in SDGs. Thank you. Back to you, Jean-René. Merci beaucoup.
Merci beaucoup, James. Thanks for this very interesting opening statement that gives us the overall framework in which this all takes place. So we have an incredible lineup of 7 speakers that represents most traits of the industry. That's from the asset owners, we have a pension fund, the index providers, the investment managers, but also the people involved in projects, the recipients of the investments. We don't have the policymakers, we don't have the regulators in the discussion, and it is deliberate, because the purpose of this discussion is really to have an industry point of view. I'm sure they're all listening very carefully and will take most of the good ideas with them. We have 1 hour, 20 minutes. It's a long panel, a lot of speakers. So we will try to have it a little bit organized in 3 themes, 3 discussion streams. Let me first introduce you the 7 speakers, and then we'll jump into the first question. Around the table, we have Yimei Li, who's the CEO of China Amc. Thanks, Yimei, to take part of this. It's really important for us to have the Chinese industry represented, the investment industry represented today, and it's really a pleasure. We have Jean-Jacques Barberis, executive board member of Amundi Group. Jean-Jacques is heading Institution and Corporate Client Division, and he has a quite impressive career path already. For those can look at the web, it is quite impressive, and is involved in most of the ESG initiatives for Amundi Group. We have Stéphane Lapicone, who's co-head of BlackRock Europe. I'm not telling you who BlackRock is. Everyone should know who they are in the investment industry. Stéphane is also leading the ESG effort within the group globally, if I understand well. Magnus Billing is representing a pension fund, Alecta. He's the CEO of that pension fund. So it will be very interesting to see his positioning in the whole value chain. He is not directing investments directly, he's using investment managers. He's having assets managed on behalf of the beneficiaries. That puts him right in the middle, in the intersection of the constraints put by the 2 sides. Dan Draper joined S&P Dow Jones a year ago, if I'm correct, it's a year ago. Incredible history into the industry from in the buy side, a few very large asset management companies, ETF issuers, and now running the indices business for S&P. No need to introduce S&P, of course. José Carlos Doherty is the chairman of International Investment Fund Association, so really representing the whole buy-side industry, and is also the CEO of the Brazilian Financial and Capital Markets Association. So probably one of the actors that is there to try to temper and to moderate and to get people do things and liaise with the policymakers and the regulators. And finally, we have Niall Hannigan, who's the CFO of Masdar. I will leave Niall introduce Masdar himself. It is a very interesting company based in the Middle East that is a leading developer and operator of energy-related projects. But we will see that there's a few initiatives that are pretty interesting, and he has a clear view on how the industry, the financial industry, can help fuel the growth into the right direction. So thanks for everyone to join us on this. The first sequence that we start now for half an hour, we'll try to respond to a very simple question. And that question is, how can sustainable investment funds contribute to 2 things? The post-pandemic recovery, that is a short-term thing, but more long-term, the achievements of sustainable development goals. To answer that question, which is broad, I would like to start with 3 eminent representatives of the fund management industry. And what I like to get from the discussion is to understand, on the first side, their role as investors, because those large asset management firms are institutional investors. They make calls, they make investment calls, but also they make decisions on what kind of products they put onto the market. That's a second side of their business. So they're institutional investors on the one hand, but they also create and design products that respond to some needs. This is really what I would like to understand. So basically, what role they see in contributing to the post-pandemic recovery and the achievement of SDGs as an investor or as a product issuer. And also I would like to know from them how they see regulation and how they expect the regulation to be aligned with the overarching objectives, and more importantly, how the transition can be handled. We hear a lot about the pace of transition, and I'd like them to give us a view on that. So in this first section, we'll try to have Yimei Li, Jean-Jacques and Stéphane to speak on this. So I'd like to offer each of them to quickly introduce their firm and themselves in a few minutes. So Yimei, do you mind starting?
Sure. Thank you very much, Jean-René. Hello, everyone. I'm Yimei Li, the CEO of China AMC. China AMC is a Beijing-based asset manager. We are one of the largest asset manager in China with an AUM of over 260 billion US dollars. We are also the largest ETF manager in China with a market share of about more than 23%, leading many innovations in this area.
Thank you very much. Jean-Jacques, quick intro.
Yes, hello everyone. It's a pleasure being with you. On my side, Amundi is an asset manager that is based in Paris, relatively important at European level and managing a little more than 2 trillion of USD at worldwide level. And specifically on the sustainability question, I would say the areas of focus we have, because we do not pretend to be good at everything on ESG, but it is in particular the climate aspect of it, the social dimension of the transition, and finally the creation of new markets to finance the transition. So that would be our 3 main areas of focus when it comes to our efforts vis-à-vis sustainability and the transition.
Thank you very much. Stéphane, a few words about BlackRock.
Yeah, so hello everyone. I'm Stéphane Lapicon. I'm the head of sustainability for BlackRock in EMEA. And BlackRock, as you know, is a large asset manager spanning about $9.5 trillion of assets across the world and all asset classes. But very importantly, we made sustainability our standard of investing 2 years ago. And this is, we believe, that fundamentally climate risk is investment risk. And we know we've reorganized all our investment business, but also the value chain of our business around sustainability. And that's my role in EMEA in particular. And I think we see that as very core to our purpose, which is to help more and more people experience financial well-being, and together with them, building a more resilient and equitable world. So that's obviously at the heart of what we do.
Thanks, Stéphane. And to jump into the first question, which will be for you, and that came from our preparation meeting, where do you see the responsibilities of your firm as an investment, as an end investor, institution investor, in moving things forward? And how do you see the alignment or the lack of alignment of the strategic objectives with the policies and rules in place?
Well, so obviously, as James mentioned at the beginning, finance has a big role to play in the transition to net zero. And I will come back to that later. But I think I would like also to remind everyone that reaching net zero alignment cannot happen without more action by governments, partnering with the private sector and the public sector, of course. But we need governments to lead the path to better technological innovation and a just transition. I would say, the money is here. Technology is often already here as well. What we need is the framework to direct the capital of our, investors, savers, to where corporates and governments need the capital. So that's an important consideration to make. You can look at the car industry when governments take very clear guidelines in terms of, when they ban the sale of diesel cars or petrol cars, that allows the whole whole industry to get organized around this and capital to be directed by asset managers and asset owners towards a new economy. So I think what we do on our side is first we build as deep as we can data and analytics tool. And this is where we've observed that the Sustainable Development Goals that have been first defined by governments to support their goals, but now actually have been adopted, if you want, by investors. And we've been able to map financial materiality from those SDGs to investment goals. This is allowing us to build, or to first give transparency to our investors on where the money is going, the impact it's having, both positive and negative alongside the SDG goals, but also direct that capital towards the outcomes that they're looking for the world. So that's a big important factor. Is SDGs have allowed, the translation from government goals, national goals, into goals for investors, and now into products to align capital with those outcomes.
Thanks, Stéphane. I'm delighted to hear that BlackRock decided to compete with Strike Insight when it comes to shedding transparency. That's a joke. That's a joke, of course. Yimei, do you want to give us a view on your perspective from China on this alignment or lack of alignment? And when we prepared the call, you made a very interesting point on the difference of stages related to the benchmarks that your institutions are exposed, which may be different to what exists in the older economies. I'm very interested in you elaborating on that.
Thank you. First of all, I think, sustainability or, ESG investment in a way, we think that as a value for all the framework in China AMC, because I think for any fundamental investor, the value is sustainability of a company in the long run. So this is very much in line with ESG. Well, if you can put it in SDG in a better way, but I do think, ESG should not be a standalone thing or product. It should be a firm value framework instead of just, something wrapped in a new product. And that being said, I do feel that ESG product or SDG product should make money for the investors. If we are trying to lose money or even not beating the benchmark, then, just economically, this is not a good business. And the investors' money are not going to flow into these sectors just because they are a good value. So in that way, I talked with Jean-Paul last time because I felt like benchmarking is crucial in the developed economy, especially in the developed capital market. But within China, currently, we are very much in a way that we can overweight a lot on the new economy. We are sometimes even, dismissing a lot of the old benchmarks because they have overweighted in, fossil fuel or even some, we call it, old economy type of investments. So in that way, I think we gain the advantage of being able to invest more of our portfolio into, new economy, new energy, new innovations, so that actually I think a lot of our investors can beat the benchmark greatly, so that they will think this is the future, of humankind, and this is the future for investments. So making money in a way that sustainable, also very important for the growth of our capital and attention from our investors in these areas.
Thank you, May. I see Dan Draper's eyes blinking at me because we speak of benchmarks, and I know we will discuss indices and benchmarks later on. Do you want to add something to this now, Dan, or are you happy to wait 20 minutes?
I couldn't agree more. Happy to wait.
Okay, terrific. The second, thanks a lot, Yimei. That's very, very, very insightful points, and we should all recognize the importance of benchmarks and how that steers capital. And probably there's some thinking to be done here to modernize a little bit the framework, even in the old continents. The second question is really about the role of asset managers as fund promoters. So basically, you guys are devising products, you are building investment solutions, and you're pushing them to the market. So you have a responsibility there in terms of shedding transparency and clarity on what your products deliver, actually, and also aligning them to the overarching goals. So the question is for Jean-Jacques, really. You made a very interesting point on the fact that you see Amundi as a creator of markets. Maybe that fits into the product discussion, I don't know. But could you shed a bit some light on this thing and how you see Amundi as an important player in creating products that matches the long-term goals?
Well, thank you very much. Well, first, I think I would concur with a lot of the things that have been said before. There are things that by definition the financial industry can do. There are things that the financial industry can do. So for instance, financial industry can decide not to invest into thermal coal anymore, but it's not the financial industry decision to close the thermal coal factories or unit or production units. And I think it's always important to remind it. It doesn't mean that we do not have a role to play, but I think when it comes to products in particular, I think the first responsibility is to be extremely clear on what does it mean to create, for instance, an aligned product vis-a-vis the clients. At the moment, for instance, if you want to build up a product that is invested only into companies that are, I would say, SBTi targets validated, it means that you invest into an investment universe on 12%. It is possible to do it, but you have to explain to the clients and to be clear to them what are the choices behind. I'm always a little skeptical when I hear that it's a pure win-win theory. At the end of the day, there might be some costs associated to some strategies, and we shall be extremely transparent about it. I think that's one of the first responsibility we have. The second responsibility we have, I believe, is that as I think most of us around the table within the industry have taken net zero commitments, it's to offer to clients a net zero product. It's as simple as that. If you want to make sure that people progressively deploy their capital into a line solution, you need to offer them some. And I think that's a responsibility that we have as well, to make sure that there is potential products to meet that growing demand, that potential demand. And the third thing, when it comes to products where I think we have a very important responsibility, and sorry, it might seem a little silly, it's to make the whole subject accessible and simple to understand, not being simplistic to the retail market in particular. You started by that. Basically, nobody knows what ESG is in the street. And probably for good, by the way. So nobody knows what it is. So at the end of the day, you need to design products and everything that is associated to it vis-a-vis clients that makes the whole subject accessible. Even tons of CO2 per million invested doesn't mean a lot for the ultimate end client of Groupe Crédit Agricole in a French region. And so therefore, I think the industry has also a role in making the whole issue less complex, if possible, and more accessible vis-a-vis the end clients.
That will be an interesting challenge to take, which is making financial solutions less complex, going beyond financial concepts. So it's going to be a tricky one, but hopefully we'll try to help you on that. Stéphane, do you want to add, BlackRock is also probably one of the largest creator of products and solutions around the world. So what is your view on this?
Well, I think, first of all, maybe going back to the benchmark point, which is a very important one, and I think it's a medium-term goal, but in the short term, we have already a lot of clients who are moving away from their existing benchmarks, keeping that existing benchmark as their benchmark, but allowing for a much larger tracking error around the benchmark, so much larger divergence from the benchmark in their portfolios, with the goal to reduce the carbon footprint, with the goal to improve alignment with certain outcomes, sustainable outcomes that they have. But that's obviously a temporary measure while we're building the benchmarks of the future. Just coming back on that point, I fully agree with the medium-term vision. I think there are still actions that can be taken in the short term by the same investors, and that's what we're seeing in a very at a very large scale here in Europe. The second point I would make is around value versus values, or are you giving up returns if you invest in sustainable investing? And I think I agree with both views here, which is there are ways to invest with sustainable outcomes that do not jeopardize your financial performance targets. But there are also other ways where, by design of the solution, as Jean-Jacques said, by design, investors will reduce the investment universe to such extent that they may give up some short-term financial performance, to reach a sustainable outcome. So what's really important here is to be very clear from the beginning on the product, not just on page 25 of the prospectus, but very clear from the marketing material and the material available to investors about this. So I think that's very clear. Then also, like Jean-Jacques said, I think in Europe now there's no question about what to do. Everyone wants to converge to net zero. It's true from citizens to governments to corporates to financial participants. So now it's about building the products. The issue, we're back to what I said before, it's the scale of those products. As long as the capital is there, the technologies are there, but there's no scheme, there's no government built consensus on how to scale those technologies and how to actually bring them to a level that will decarbonize the planet. It's hard for capital to go there en masse. So that's I think that to us it's the next level of achievements we need to get collectively, is to define the decarbonization paths that governments want to play around the world, and then direct the capital in that direction. It's very hard to go against what a sector or government will do as an investor. The more clarity you have, the more certainty you have, the more money you're going to put in that sector, and the less risk premium you're going to ask for that money as well.
Thanks, Stéphane. And question for both of you: do you think it is feasible, or is it a dream to expect that the industry will be in a position to communicate correctly and the investor understand correctly what you just explained, which is that the fact that they may have to accept a different risk-return profile because we now take into consideration some externalities or costs or transition costs? Do you think this is something the investors can hear? Because whatever we think, investors remain short-term focused.
Maybe let me clarify what I said, because I'm not sure I was clear then. I would say if you invest medium term and you invest alongside the net zero transition, we believe this is the best way to actually have the best financial outcomes for an investor. So that's very clear. And this is where we say climate risk is investment risk, but investment risk also means huge opportunities to invest into the net zero transition. So for us, there is no doubt about this. I think I was just referring to a point that Jean-Jacques made, which is a valid point, which is to say there are certain products that are very niche and are targeting very certain parts where we don't know whether the financial performance will be impaired or not by versus a benchmark. But what we know is that we can build sustainable outcomes around that's the impact products, whether you invest in renewable energy, whether you invest into certain new technologies. That part is, you cannot give a guarantee of financial performance. But if you play the net zero transition as an investor in the medium term, our conviction as an investor that you will actually achieve the best financial performance for your portfolios by doing so.
Thanks. You made an interesting point about the fact that ESG is a state of mind, and I think all agree on this. Now, a state of mind is a concept. It's in people's minds by nature. It's not measurable. What can be measured is rules, is products, is metrics. So how do you think the industry can move forward in terms of making certain the state of mind moves into the right direction? So there's a number of attempts to create frameworks to do that. But do you see these frameworks perfectly aligned with the long-term objectives on the one hand and your regulatory constraints on the other hand? And that's a question for you three. Yimei, if you want to start on this.
Yes, I agree with what both of the panelists spoke before about the creation of the products. So definitely we went through exactly what you have actually worried, because we had a fund called China AMC Energy Renovation Fund, and it underperformed the market for like 2 years. But in the past 2 years, it has been the best performing, of all the products in China. So it's the top 10. It has an annual return of 100% in the last year. So we have to make it clear about our theme of the product, what is the area of concentration, and then we educate the investors sustainability of this sector. So the key is to persuade the audience of what your value is. So this is not only about, you know, a theme. This is about what we believe in the long run that will solve the problem of the planet and at the same time push the innovation of the technology. So I believe that the framework should be there to support our fundamental research of what will drive the next cycle of innovation in technology, what will be the disruptive innovations that probably will address both E and S at the same time. So in that way, we had really successful pilot program in this area. And I think in China, we have the luxury of the regulators and especially our state government is on our side in making it a state strategy of, you know, carbon picking and carbon neutralization. So in that way, I think we need to educate our regulators. We need to educate the listed companies to do more disclosure and, you know, steer their strategy towards longer term sustainability. And we really need to educate our end investors to believe in the future of this path.
Thanks, Stéphane. Jean-Jacques, anything to add to this before we move to the last question? Jean-Jacques, yes, you raise your hand.
No, I think when it comes to alignment, I think for the industry, I think we need to think about two things. The first thing is to set up, I would say, credible short-term targets. I do have a lot of sympathy for 2050 targets, but I believe that a number of the people around this panel will not be in charge of their respective companies at the time. So I think to have, I would say, credible short-term, and when I mean short-term, it's 2025, targets and reporting on the associated achievements is a way to be credible or to prove that we cannot do it, but at least if you want to be credible, you need to be a little short term first. And second, I think it's a matter of alignment of our own governances. I think the asset management industry is super good at asking a number of things to other companies, but basically, what are we doing for ourselves? So basically, where do we position the ESG responsible in the governance? Is it directly at general management? Is it at marketing? Where is it? Second, how are the KPIs of the firm aligned vis-a-vis sustainability goals? And for instance, sorry, but basic things, is the compensation of the top executive of our firms, I would say, associated to the correct deployment of our net zero plans? For how much? Is it 5%, 10%, 20%, 50%? I think these are very practical things. Third, how do we imply our own governance, for instance, our shareholder meetings? A number of us are quite supportive of corporates putting say on climate at their general shareholder meetings. Maybe it will be also time for the financial industry itself and for its companies to propose to its own shareholders says on climate and its strategies. So I think if we want to align, we need to be credible ourselves. It is very difficult, it's tough, but I think we're entering into a moment where basically things are getting extremely and for good serious on this type of subjects, and therefore we need to demonstrate that we are serious as well.
Thanks, Jean-Jacques, that's very interesting. I would like to add to the dimension of time, the fact that there's different time horizons to take into consideration, that there is also some specific situations in different regions, in different segments of the populations, generations. So I guess that we could all agree that one size will not fit all. So managing the timescale is one issue. How do you think we could manage also the specifics of the different countries, the different population segments, not to have any unwanted consequences that may be really bad for some parts? Stéphane, do you want to comment on that?
Well, yeah, I think it's, my answer would be quite obvious. It's a global problem that calls for global solutions. So you can have different countries or different sectors actually going at different speed, as long as it's part of the global plan that gets us to net zero. And then it's the responsibility of governments and also corporates and financial sectors to, work across the globe along those objectives. So, one area we've been very focused on at BlackRock is how do we bring the capital and the expertise that have developed in certain markets on renewable energy, renewable infrastructure in particular, and bring that to other countries that have not had that same development yet on those infrastructure and those technologies. And how do we bring the capital in a way that's safe for investors? And that's where you can marry private and public sector when you need catalytic capital from financial institutions globally, public institutions, and then bring private capital to support it and accelerate that. So that's what we've done with a fund called Climate Fund Partnership that's exporting renewables technology and infrastructure to other parts of the world than Western Europe and the US. And that's actually, it's a small fund for now, but it's going to be hopefully a template for other funds we do or others do to do this at scale.
Thanks, Stefan. When we prepared, you raised a point that I also found very, very striking, which is the fact that it's good to focus on the long term, on the long trends and the short-term changes of that, but we should also not avoid the unavoidable short-term impacts of what is already there in terms of climate change or in terms of impact of the changes we force onto the world. Do you mind elaborating a little bit on that, please?
Sure. Well, I think in the past several years, especially this year, especially in China, we have seen a great deal of anomalies in the climate change impacting everyday life. Well, we have seen, deserts flooding right now, places that rarely rains have floods as well. So I do think that when we were preparing to actually have impact on the global warming, to cut down the carbon, to cut down the different energy sectors, we need to also focus on the infrastructure that will prepare our people for the climate change already happening day to day. And I don't think that we are prepared for a very floody desert, or the infrastructure is just not there to cope with very heavy rain and showers and storms during springtime. So in that way, I do think, well, as investors, as financial organizations, we also should have the responsibility on the social part of this climate change, so that we can not only have sustainable growth for the companies, but have sustainable living standards for everyone on this planet.
Jean-Jacques, you want to conclude on the social aspect of things, because that was how you introduced yourself?
I would concur a lot with what has been just said. We are all focusing on mitigation efforts that are absolutely key, but the adaptation efforts are probably as well as important. And I think probably we're at a moment where maybe our industry should think about the fact that climate change is not a risk anymore. It's a risk that is certain to occur if we do not act, and that has already some consequences. And it's extremely different to have that approach in terms of a risk perspective than we used to have it even 5 years ago. So I think that's really something we should have in mind as well in communicating vis-a-vis what we consider as a risk vis-a-vis our clients, because I really concur. I think we have entered the climate crisis already, and therefore it's not a risk anymore.
Thanks, Jean-Jacques. So I think we can conclude on this sequence that even though there's consensus, there's a wide different point of views. You probably share them all, but it all goes into different directions. So that's pretty good. Doesn't mean it make the situation easier to manage. It is extremely complex. We see a time constraint. We see a specific constraints, with the complexity of matching the policies and the regulation with the long-term objectives. So it's really not easy. So I'd like to thank you three for your input into this first sequence. I would like to suggest, if your agenda permits, that you stay on board longer, and feel free to interrupt or move into the discussion going forward. So I'd like to enter the second sequence of this discussion. And here the question we will try to answer is, how can we move from niche to the norm? Basically, ESG started as a niche. It's growing, but it's still not the bulk of the investments. So what is the role of market leaders into this transition? And for that discussion, I'm glad to have two senior industry representatives from the buy side, the pension fund, with Magnus Billing, CEO of Alecta, who used to work for a market operator. So he also has a broad view that goes beyond simply allocating capital for his pensionees. And Magnus has been very active into the sustainable investment space. Dan Draper, CEO of S&P Dow Jones Indices, as I mentioned earlier, an incredible career in the product side with ETFs and mutual funds. I won't list the names of the people you work for. That's easy to find, but it's quite impressive tableau. So Magnus, do you want to introduce your firm in a few minutes, please?
Thank you, Jean-René, and thank you for having me here today. It's a privilege for me, and I'm very intrigued by the discussion and on this very important topic. So Alecta is a pension fund, as you mentioned, Jean-René. We manage about $130 billion. We're a mutually owned pension fund, so all the profit and all the cost is directly to our customers. There are about 2.6 million people saving for the retirement, which gives us a great opportunity to work with the concept of sustainability, because the liability side of our balance sheet has extreme long-term view. It's 30-40 years perspective on it. And that has been the entry point for us to try to conform our portfolio into sustainable portfolio, and with a focus on ensuring that it's net zero by 2050, but also committing to milestones around on this pathway towards net zero. So we have committed to a reduction on 25% on the equity side, 25% on the fixed income side, and minus 50% on the real asset side by 2025. And the key drivers for us in this context has been the clear message from our customers that we expect Alecta to manage our money in a responsible manner. And then we can have a long discussion on what does that mean. And obviously it will mean very different if you talk to a customer who's 25 years old, just starting to save up for his retirement, or whether you're 63 and sort of getting closer to the point where you want to see pension being paid out. But end of the day, it's about managing their money in a responsible manner.
Thanks, Magnus. Dan?
Hi, it's great to join you. Thanks for the invitation, Jean-René. So I'm Dan Draper, CEO of S&P Dow Jones Indices. We're the world's leading provider of index and benchmarking solutions around the world to a whole variety of kind of index and investment constituents, including governments and obviously the private sector. We're well known for the S&P 500 and the Dow Jones Industrial Average. We now have over 150 ESG and sustainability related indices, including versions now on our S&P 500 ESG. And we actually created one of the first sustainability indexes, the Dow Jones Sustainability World Index, back in 1999.
Thanks, and I can confirm that the S&P is the most thought term on our platform. So it's interesting to see that you're leading brands into the index space. So when it comes to equities. So thanks, Dan. Following on the discussion we had earlier on the pace of change and the fact that things needs to be timed and structured and maybe made specific, could we dive into more details in what are the main forces here at work? Because the industry is quite complex between the asset owners, the recipients of the funds, there's the index providers, there's the asset management firms, being institutional investors or product issuers. So what are the main forces at work, and what is the role of the side participants, which are not really the side, such as the index providers, and how can those players help in aligning the long-term objectives, keeping into consideration the externalities and the different asset liabilities constraints in line with the day-to-day elaboration of products and solutions? Dan?
Yeah, so I think the kind of the nature of the role first, kind of definitionally, as an index and benchmark provider, S&P, we don't give investment advice. We're not a fiduciary. And that's why the independence and the transparency of what we do is really, really crucial to fiduciaries, you know, like Magnus or BlackRock, Amundi, China Asset Management, and what they do in their roles. And that's really important, because if you look a little bit at the history of indexing, you know, the Dow Jones Industrial Average is 125 years old this year. And Jean-René, we talked about, I used the term a barometer. And that was the real key. I mean, at that stage, arguably, when the United States was moving from emerging to developed markets way back then, Charles Dow was trying to find a measurement, a barometer of the overall economy. And at that time, we didn't have a lot of government statistics. So basically looking at converting at that time a barometer based on stock prices into today becoming a benchmark, thinking about risk-adjusted returns. And that's also important, not just to the private sector, but to governments. As we're now building a taxonomy, we all want to have reliable benchmarks, and talking about the evolution of that is absolutely crucial. So that's really, I think, where we are, is we have policymakers, society is asking for ways to really think about benchmarking and what role can private sector play. And this is crucial. Earlier participants talked about this transition, but you have fiduciary responsibilities today of the current world, but the world we're moving to. So how are we taking to build the independent benchmarks? How can we when we have to, as a fiduciary, the fiduciaries on this call have to deliver risk-adjusted performance for long-term, medium, and even short-term investors in the marketplace? And that's really where I think the role of building reliable data, converting to benchmarks, and then those benchmarks becoming investable products that provide practical applications. And what I'll kind of close on this question is, but through that process, it is building from a private sector perspective, an ecosystem. So having long-term investors like asset owners, sovereign wealth funds on the one end, but you do need this new information, this new data that's being processed in the marketplace. You need short-term participants, you need exchanges, you need short-term traders, because providing price discovery is valuable information and eventually setting these benchmarks going forward. So we believe our role is really across that investment ecosystem for long-term investors, but also the short-term is providing more data, more relative kind of benchmarking, but providing overall better information across the investment ecosystem to create these standard benchmarks, which can really help investors of all types.
So to summarize, your point is that the index providers will be very important in shaping the benchmarks of the future and are essential to this transition. Magnus, Magnus, as a asset owner with long-term objective, and as a creator of solutions and products for one of the fastest developing region, what are your asks to Dan? What would you ask the index provider to deliver and to put on the table to fit with your new needs coming in reality in this new world? Magnus, any idea on this?
Well, I think it's a general theme of long-termism. I think we all struggling a little bit with the short-termists that are vested into the investment chain across the board. Sort of we have a investment chain which is being skewed towards short-termism, and it's not aligned with the end beneficiary's long-term view, being a pension saver. So I think that is a key theme going through all these market participants here, including the index providers.
Yimei, do you want to add something to this?
Yeah, certainly. Thank you so much, Dan. I think the index provider is key, because I think for ESG and for any long-term investment, transparency is always better than just within a black box. And certainly I think index and benchmarking is why the whole industry is going so long-term and so sustainable in such a long time. But I do have two things I want to recommend. One is there's definitely country specific, because every different country or region, they have very different views or priorities in going into the long-term plan of the sustainability or ESG. So we probably should take more that into consideration. And two, I do think that how to is that possibility to redefine or to change the SP 500, something like that, to long existing index to a better one, instead of introducing a completely new one, so that the whole universe of product needs to be revised. So this is something I think very important to the investment community. Thank you.
It's great feedback. If I could reply, I think what maybe early days was taking more exclusionary approaches. I think what you're hitting again, as particularly as from a fiduciary perspective, is trying to get the broader market representation like the S&P 500. But I think being able to look, if you will, a bit more of the bottoms up. And I think that comes from the dual side not only kind of for us index or benchmark construction, or if you think portfolio, but also getting more company participation. And as referred to, we have huge gaps in terms of company disclosure. You know, many companies, even in the US, aspirationally talk about their ESG or their sustainability goals, but very few actually are disclosing at the moment. So this is where can we encourage more disclosure? We have a patchwork of reliable ESG data. How can we get kind of better, more consistent data, you know, throughout there to be able to rank and measure? And that's where the ecosystem works, because you have, if you will, from an investor or an index perspective, but then you can feed bottom up companies who will then be encouraged to actually disclose more and provide the data in a way where they can actually see benefits to do that. So that's really where we see, if you will, indexing and benchmarking as a portal between both sides, linking, you know, the fiduciaries on this call, but also encouraging companies to really, you know, commit to disclosure and working within these, you know, increasingly international standards.
Thanks, Dada. I didn't know that EMA would ask you to reshuffle the S&P. That was not planned at all in our discussion.
We've actually done that. We do have the ESG, S&P 500 ESG version now. So.
Magnus, thanks a lot, Dan and EMA, for this interesting point. Magnus, from the initial conversations we had, I recall that you told me that you were not prepared to wait for the industry and the regulator to do the things, and that you had an agenda, you had to move forward. What is the role of firms like you and your part of the industry, related associations and industry bodies, from the buy side, from the asset owners, in driving the momentum in the right direction? Do you have a view on this?
Well, I think two of the key drivers that are pushing us forward right now is one that I mentioned earlier, the customer side, the end beneficiary. It's a clear message from them, and as Dan talked about fiduciary duty, that it's in the center of all of it. So we have to sort of comply with that and do what is expected from us from the customer side. So that is an extremely strong momentum right now. The second part, which I think is also sort of on a standalone basis vis-a-vis the policymakers today, is that you start to see a lot of corporates out there that are transforming their business model to make it future-proof for an environment where we don't depend on fossil fuel to the extent we're doing today. And in order for us to be a good investor and be able to capture the value creation in the future, we need to understand this better. We need to be on top of this. So those two drivers are extremely strong today. But I think we need the policymakers, and others have pointed that out earlier in these discussions. I don't think we will be able to get where we want to get without the policymakers taking a few more steps going forward. Just give one example on the climate side. I mean, we stress our portfolio with a number of climate scenarios based on the IPCC report and the IEA report, where we discount carbon pricing from 2040, 2050 down to today. Clearly, you will come to a conclusion where the market value in our portfolio is lower than the market price is showing today, and that's the fact of failure to internalize the externalities of carbon emissions, right? So we have some sort of market failure in the marketplace today. And I think we will not be able to solve that unless we get the support from the policymaker. And what I'm talking about is we need a carbon price. We need a global carbon price in order to get to a point where we can do this all the way.
Thanks, Magnus. Jean-Jacques, Stéphane, or José or Niall, do you want to add anything on this sequence, something that you heard or you want to react upon?
Yeah, yes, maybe to echo what Magnus just said. I think our analysis is that the price of physical risks from climate transition is actually already higher than the price of transition. So not doing it, the cost of not doing anything is higher than the cost of doing something. And the more we wait, the more the difference will increase. So it's, this is where it's so important to take actions now. Transition risk is about taking measures that will be an investment outlay upfront for a better outcome, whereas not doing anything obviously will create value destruction. So that's point number one. And point number two, also to what Magnus said, we are working very closely now with corporates and in their sector, by sectors, but also investors to find a way to provide them what we call transition finance, which is how they can help fund the scalability of the technologies they've developed or the greening of their sector, of their companies. Again, we can't do this on our own. Our clients can't do this on their own, but this dialogue has to be get momentum. And again, the more clarity, the more certainty, the faster we can go there.
Excellent, thanks. So we're spot on time, so I'm glad we can start sequence 3. And the topic here we would like to cover is, okay, we understand there's a lot of different players, from the recipients of the funds, there's the asset owners, there's the portfolio managers, the index providers, then the policymakers, the regulators, and the governments. There's a lot of people here. We understand it's complex to align everyone and to align things that are translated in easy to understand rules, not even speaking about investors. So here I'm trying to have you speak about how can we improve the quality and maximize the development of sustainable investment funds, and what is the role of organizations such as UNCTAD? You correctly pointed out when we started that the SDGs now seem to be taking not shape, but they're taking on. Investors are embracing them. Which means that now it seems industry is ready to follow them, but that is a reaction. How can we have organizations such as UNCTAD contribute to even further accelerating the trend? What is the role of associations, of industry associations? So here I'm delighted to have José, who's the chairman of International Investment Fund Association. Interesting to point out that he's been a market supervisor before, so he knows about market supervision and regulation. And we have Niall Hannigan from Masdar, and I'll let him to introduce his company. So José, do you want to say a few words about your organizations, both the International Investment Fund Association and the Brazilian Financial and Capital Markets Association you're running?
Yes, of course. Well, hello, everyone. Thank you, Jean-René, for the kind introduction, and I would like also to thank UNCTAD in the name of Young Fu for inviting me to participate in this conference with so distinguished panelists. Well, I'm CEO of ANBIMA. ANBIMA is the Brazilian Capital Market Association. It's an advocacy and a self-regulatory body for the Brazilian capital market. More specifically, we act on the investment fund industry here in Brazil. I am also chairman of the IIFA, the International Investment Fund Association, which I believe most of you already know what is IIFA. And IIFA currently congregates 43 investment funds associations representing around $70 trillion under management in regulated funds. I think that's the background here, Jean-René.
Thanks a lot. Niall, do you want introducing Masdar? Tell us about the projects and what you're running, but also the more funky projects that you're carrying in Middle East.
Yeah, happy to do so, and delighted to be here. I think the first thing I would say is Masdar is very, very different to any of the other organizations represented by my fellow panelists today. We were established in 2006 by the government of Abu Dhabi to essentially realize a strategic ambition for a more sustainable future that was anchored in future clean and sustainable technologies and renewable energy. So we're not a fund. We're an investor, developer, owner and operator of renewable energy and sustainable real estate assets. Over the last 15 years since we've been established, we've committed to invest over $20 billion in renewable energy projects in over 30 countries worldwide. And we've been significantly advancing the development of Masdar City, which is a benchmark for sustainable urban development and urban living here in the region. So we're the organization and the company that is most likely to be tapping into the institutional pools of capital to help us fuel our further growth, rather than the entity that is actually taking third-party capital and managing it on their behalf. We're active all across the full spectrum of the energy transition, So we are investing in developing in the generation space. We are active across the energy efficiency space, decarbonisation through carbon capture and storage and waste to energy. And we're also in the advancement of new technologies. So we're actively looking at the advancement of energy efficient desalination, battery storage, and green hydrogen. So that's Masdar.
Thanks, Niall. The experience you're referring is fascinating. It really allows to understand how long-term interest can be put in motion still with short-term objectives. It's pretty interesting. We understand you're the end beneficiary, you're the owner of your assets, and you invest your own money. But what is your view on how the financial system can contribute to the trend you're setting in your region? You mentioned to me a number of initiatives to build funds around the initiatives you run. Can you detail this a little bit?
Yeah, most definitely. I mean, as I said, we're a developer, and in order to obviously continue to develop and grow the renewable energy sector in the markets that we're active in, and we're very active in developing markets as well as the developed market spaces, you know, we look to tap into available pools of capital. So be that traditional financial institutions, but also, as we see, you know, represented by everybody, or the majority of people on this call, there's huge amount of capital looking to go into the ESG space. So what we're looking to do as a developer is to start to package our assets and to try and create assets that investors, pension funds and the like that are looking for ESG related investments are able to put their capital into. So in the last 18 months, we've established, for example, in the UAE, the first green REIT, which is focused on purely sustainable assets built to LEED Platinum and LEED Gold standards. We're also very much taking the lead in transparency. For us, while we may want to attract pools of institutional capital to help fuel further growth, we recognize that those pools of capital want to see far greater transparency. So rather than wait for regulation in our part of the world, for the last 8 years, we have been issuing a sustainability report that doesn't just look at our sustainability credentials and what we are doing, but also quantifies and reports on the outcomes and impact that we are actually delivering from those assets. So for us, what we're trying to do, I would say, is really try and build a bridge between the pools of capital that are looking to invest in the ESG space and the actual underlying assets.
Thanks. That's fascinating, and I'm sure you won't find a lot of difficulties to pull investments given the interest in real assets in infrastructure projects these days.
No, but if I could just say, we don't, but the one thing I would say is we are very, very active. There is a huge amount of capital, and I'm probably speaking from a broader sector perspective and renewables perspective, but there's a huge amount of capital available for the renewable energy space. The issue is it's not always going to the markets that need it the most, i.e. the developing markets. The other issue is it's not necessarily going to the technologies that are going to play a huge role in the energy transition. It's going to the more established wind and solar technologies. So while there is a huge amount of capital out there, and while we can tap into capital from whether it's the capital markets or from the traditional banking institutions, it is much more challenging when you're looking at trying to introduce capital for A, developing markets, and B, new technologies. And that is something where I think a significant amount of work is going to need to take place, and where a lot of collaboration. A number of the panelists talked about the roles of governments, and I think particularly in developing markets, collaboration between financial institutions, developers, and regulatory bodies will be absolutely key to making sure that capital is going to the markets that need it the most.
Thanks. I think you had the attention of most of us on the panel today, so you've been heard, I think. Jose, following the previous conversation, the role of the markets, the policymakers and regulators, you mentioned self-regulation as an important element. You also mentioned when we prepared a call that probably, again, it wasn't a good idea to wait for things to happen, and that you wanted to help and push the industry move forward faster sooner rather than later. Do you want to elaborate on this, on how the industry and organizations such as yours can help push the boundaries faster than just waiting for the governments to go through policies and then regulation?
Yes, of course, René. I might repeat or reinforce some of the comments from our colleagues here in the panel, but apologize for that. But they're very good comments, very good suggestions, and which is good because it shows that in general terms, the industry, the portfolio management industry it's already aligned with what needs to be done. But going here to your question, to your comment, there's, in my view, there's a lot of things to do, a lot of actions to be taken from the different players in the investment fund system, investment fund chain, if you can call like that. Let's start with the, if I'm not mistaken, was Dan that mentioned this in the previous session. So let's start with the infrastructure, as we call infrastructure, or market operators. So the stock exchange have a very important role to play here in terms, not only in terms of benchmarking, but in terms of connecting the companies, the corporations with the portfolio managers, with the regulators, and preparing the companies to be more transparent and more informative in terms of the ESG goals and ESG principles that they are following. So the infrastructure has a very important role to play here. Associations such as ANBIMA that you have around the world, so they're also very important if you think about connecting the investor with the ESG principles. I mean, putting together content, putting together substance, and informing and helping to educate the investors in terms of ESG principles, in terms of sustainable development goals. This is very important because if you don't have, I think was Lee that mentioned this in her notes. So the investor here, it's crucial. So if you don't bring the investor to the chain of ESG or of the sustainable development goals, there will be a huge gap here. So associations such as ANBIMA and others around the world are very important to play this role. You mentioned self-regulatory activity. ANBIMA and other organizations around the world play this role of self-regulatory activity. I'll give you the example here. Probably the panelists know IOSCO very recently, I think it was last July, they launched the consultation report. It's called, I'm going to read here because it's a long name, Recommendation on Sustainability Related Practices, Policies, Procedures, and Disclosure in Asset Management. So what does it mean? It means that the regulators are preparing themselves. So they are learning, they are discussing the topic in areas such as practices, policy, product disclosure, supervision, terminology, investor education. So we know as industry representatives, as industry, we know that the regulators are working, are doing their part. My view is that regulators have to do their part, but let's work here towards a more principle-based legislation or more principle-based policy. How we are going to do this is the industry getting together, sitting with the regulators and say, here, let's work towards a more principle-based legislation. Let's avoid let's avoid a very prescriptive legislation, because every time that you have a very detailed legislation, you are blocking the innovation, you are blocking the experience that the market can bring. And at the same time, you are assuming a as market representatives, you are assuming a responsibility that we are going to fill this gap. I think it was Magnus that mentioned that is really a gap here, that the industry can fill this gap. It's exactly through filling this gap through self-regulatory activity or proposing education to investors, proposing terminology, proposing standards, that the industry will fill this gap, and in a good way, it's going to avoid a more restrictive legislation. And they're at the same time, they are doing their fiduciary responsibility, which is to bring the experience and the how can I say, the beneficial owner fiduciary responsibility that the portfolio manager has. So they have to bring this to the table to discuss with the regulators, and I mean not only with IOSCO, but with each regulator in each jurisdiction that you're based. So that's a first thought here.
That's a very interesting point you made about rules versus principle regulation, and we've seen it in other areas like MiFID recently. I guess you're navigating the global space of regulation because you speak to everyone in the world. Do you think it will be possible to have one voice that finds a way to harmonize this? We know that Europe and US already have, and the Anglo-Saxon we have completely different ways of looking at regulation. I'm not sure about China. So is it not simply a nightmare that we are creating if we wish to have one consensual way to do things? The principal regulation is ideal, but difficult to control and to monitor. Rule-based is easy to control, but that has a lot of adverse effects, and the industry is and everyone is very good at respecting the rules, but not the principles behind. So it's probably not the good option. How do you see this going forward? And do you see a role for UNCTAD, who's basically the mother of the SDGs, to have a kind of role in this, to make certain that the principles that lay behind the SDGs are in effect translated into reality?
Yes, well, it's very challenging for an international organization such as IIFA and others to concentrate and to be the only voice to discuss the topic. Especially, in my view, especially when we are dealing with legislation or policymakers and regulatory aspects, because on that matters, that's why principle-based legislation is important, because you can have like a big umbrella dealing with principle-based legislation, but at the end of the day, each country, each jurisdiction, or each industry will be able to discuss the details of the legislation of their country. And because of that, and why is that? It's because it's, especially on the ESG aspect here, the mature of each market are very different. So you have mature markets like the European markets, very mature, but when you come here to South America or maybe in other regions, the mature of the market players and the investors are completely different from, for example, the US or the European market. So in terms of legislation, I think it's very challenging, it's very difficult to have one body discussing this internationally speaking. But the experience of these international bodies shows to us that in issues or topics such as ESG, it's better to take some common grounds here, some topics that are easy to have a more aligned position or a more aligned voice. For example, as I mentioned before, information to companies, capacity of market professionals in terms of ESG products and ESG understanding, investor education. So for these topics that you can more easily align the interests and you can work more internationally, I see a very interesting space to have, for example, as you mentioned, UNCTAD jumping in, organizing, coordinating, and being a body to centralize the information and the guidelines to prepare the market professionals to distribute information to investors and work on that scenario. In terms of legislation, I think my view is that it works better to have each jurisdiction or each region working with their specific topics in relation to ESG.
Thanks. I'm glad you made those comments, and I hope James heard them very well. I know from the discussions with James and Yong-Fu that the UNCTAD is looking very seriously on the SDGs and how they will result in reality across the world. And I would reemphasize the importance of them taking this very seriously so that it really delivers. That's very important. I'd like to finish on a question for Niall. You have the hands in the sand and the cement, really. You're in the projects. You're not in the financial industry. You're not managing assets. So you're really there. So I guess all those discussions about policies, about regulation, are really far from your day-to-day life. I guess you can't wait for the policies and the regulation to happen. How basically do you handle it? And how do you basically suggest moving forward for people that are really in the projects?
Well, I think when you talk about, say, policy and regulation, I mean, one aspect of it is, I guess we look at the whole issue of, you know, as an organization that's potentially going to tap into the institutional ESG capital markets. How are we going to do that, and how are we going to make sure that we are best positioned to do that and make it easier for ESG investors and funds to be able to see us as a potential investment. And for that, we're not waiting around for really the guidelines and for them to tell us. As I mentioned earlier, we're being very proactive and just being transparent. We're making sure that each and every one of the investments that we do, and everything, our entire mandate is to do investments in sustainable, renewable energy, clean technologies and the like. But we're making sure that we're being proactive in terms of our transparency, our reporting, our sharing of information, rather than waiting around for regulation. So that's one aspect of it. The other aspect, which is probably a complete sort of tangent from the broader conversation we've had here today, is really, again, ultimately, for ESG investment continue to grow, you have to have the real assets. You need somewhere at the end of all of this, there are the real assets. And that's the space that we play in. The space that we are very active in is the development of those real assets. And for us, as a developer in renewable energy markets, in developing market spaces, you know, we actually, again, cannot really wait for those frameworks to be developed. We have to work in partnership with governments, with regulators, with financial institutions to actually put in place frameworks around renewable energy programs that are long-term, that are sustainable. And then we have to work with them as we implement them to make those frameworks more comfortable for a broader investor group. And typically what we've seen, and I know this is a tangent, but typically what we've seen is, what is the evolution? The evolution for a developing market is, on day one, the only pools of capital going in are development equity like ourselves and development banks. You then transition to introducing the commercial banks. They start to get a feel for it. They start to get more comfortable with the risk profile. And really it then takes another cycle before we start seeing institutional pools of capital like those represented here to start entering those marketplaces. And I think what's an interesting challenge for us as a developer, and probably in partnership with some of the people represented on the call today, is how can we accelerate the pools of capital that represent institutional ESG investors? How can we accelerate the movement of those pools of capital into the developing markets? Because while there is an awful lot of money, and I'll say this again, it's not necessarily going to the places it needs to go. And that means that development of ESG solutions, environmental solutions, renewable energy programs that are essential to certain countries are not happening as quickly as they need to happen. And I think the one thing people will hopefully agree on is that with the problem is today and the speed at which we're addressing the problem is still not quick enough. And that can only be addressed by mobilizing all of the pools of capital available into the markets that need it the most.
I want to conclude on these words. I'm delighted you made the point that clearly. We have a few minutes, and thanks now for this. We have a few minutes left. I'd like to give everyone a chance to give a concluding thought, a quick 1 minute. Magnus, do you want to conclude on something?
I just, yeah, thank you very much. I just maybe touch upon a little bit what Neil said here. I think it's very important. I think in order to create the momentum and the speed necessary, it's critical to make that bridge that Neil is talking about. I mean, just look at Alecta, for example. We are a small company. We have a large capital to manage, and therefore it's a challenge for us to enter into new markets, developing countries. So we are in need for catalysts like multinational development banks, national development banks to manage scalability, risk mitigations, and then you can facilitate the allocation of the capital towards that. So I think I fully agree with Neil is saying, and I think that's a very important point in order to really have a meaningful allocation of capital towards developing countries going forward.
Thanks, very important feedback in the loop. Jean-Jacques, do you want to conclude on your vision of the Amundi Group on all what you heard?
I would echo what Magnus just said. I think particularly in a context where at some point in time, budgetary money is going to become a scarce resource again. Let's hope that at some point in time, we're going to get back into a moment where public money is going to be considered as a scarce resource. I think the type of model that Magnus just elaborated on is extremely promising also in a post-COVID environment, because it's where you can use public money to guarantee or de-risk partially the investors, leaving them a part of the risks, to allocate properly the capital where it should be. So I think also as we're going to enter more and more into a moment where we're going to readdress the questions of our deficits and our, I would say, debt objectives, it is important to have that in mind to design I believe, the proper ways to channel private investment.
Thanks a lot, Dan.
Yeah, look, I think we spent a lot of time on the investment content. So how do we have better data, building better benchmarks, between providers of capital and investors of capital? But I did want to take a couple of minutes to talk about, to policymakers and others, use the private sector around innovation and accessibility. Jean-René, think about ETFs. We believe that over the last 25 years, the shift to passive has saved investors globally $357 billion in lower fees. And it's global. And firms like BlackRock, Amundi, China Asset Management are kind of leading that charge. But I would implore policymakers lean into the innovation of the private sector to make these strategies and investments more accessible around the world.
Thanks a lot. And you don't have to ask me to think of ETFs. I dream of ETFs. I'm a bit conflicted in that. Thanks a lot, Dan. Stefan, any concluding thoughts?
Yes, maybe I would say the 5 things that will accelerate what we've discussed is more ambitious short-term goals. Sometimes some people have said that already. That's very important, both from governments, from corporates, and from the industry. Very critical. Pricing externalities, including carbon, of course. That's a must at the global level. Better disclosure. We've said that as well several times, both from corporates, but also from financial players on their products. Greening multilateral international finance. We've heard that as well, to bring the capital where it needs to go on developing markets. And then finally, the right incentives and industrial policies to target capital to early venture, late venture, and early growth to scale technologies to where they need to go.
Thanks. José, one comment?
Well, just to reinforce, I think it's time really to have the industry fill in this gap. Don't wait for the policymakers or the regulators to establish the legal framework. So it's everyone in the industry has a stake and has something to do and to fill this gap regarding ESG principles and sustainable goals.
Thanks, Yimi. I know you changed your agenda to stay until the end, so thank you very much for that. So it's up to you to give the final concluding thoughts on this conversation.
Sorry, I have to unmute myself, but I'm glad to be part of this conversation. And as asset manager in developing country, I think, well, I want to say four parts. One is we need to build our in-house capability in research. This is crucial for our fundamental development. Two, I think we do need to raise awareness of the investors and the governance, the regulators, because we want to push this forward in the long run. Three, we really need to engage with the listed companies to increase their disclosure. I think the local boutique really have that expertise in this area and the local connections. Four, I really want to say that we need to make better return for our investors so that everyone can get on board. And China, we probably has to spend additional more than 20 trillion in its energy sector to reach carbon peak and neutrality. So we welcome international investors to invest in China and especially our energy renewal sector. And we think this in the long run will be one of the most, well, I won't say, making the best money, but I think it's not only the best for your portfolio, but also the best for the, environment as a whole. Thank you.
Thank you very much. And I think there were a number of very, very good points raised during this 1 hour and a half. We made the timing, we're 2 minutes late. So I would like to thank each of you for your patience, for the insight, for the time you spent with me preparing this call. I think it was a very, very interesting discussion. I'd like to leave giving you away some thoughts, and we don't need an answer on that. There's 17 sustainable development goals. 80% of the funds focus on one, climate. So what about the others? Poverty, live below the water, above the water, education. So message for the investment side of the industry, the product producers. There's, I think, a hell amount of innovation to create products that also offer responses to those more long-term, but equally important things that need to change in the world. So thank you very much for your time. And I hope you enjoyed this moment. Thanks a lot. Bye.